Let's bring in Bernie McTernan, analyst from Rosenblatt Securities. He's got a buy rating on Disney and a $170 price target. We should have had 10 million on day one, is why this is a headline. Bernie, what's your take, and how much has this surpassed expectations?
Yeah, so 10 million signups. So the question is how many convert to paying subscribers. We think there's actually going to be a large amount of those will convert to paying subscribers because, one, the deal with Verizon, so we think a lot of customers are getting them for free, and then two, the content rollout. So a show like The Mandalorian, they only released the first episode last night. The second episode is going to be this Friday, and it's going to be every Friday at the end of the year. So we think a high amount of those 10 million subscribers will convert, and that beats a bogey of a mid to high single-digit number that the buy side was at for what they thought Disney would announce for the December quarter.
Where are you looking for the next leg of growth?
Yeah, so I think we'll continue to get growth here. We haven't even had a weekend yet. You know, a Tuesday night, maybe not everyone's around.
Oh, but let's push forward anyway.
Exactly. But one interesting thing, we did a streaming video survey a couple weeks back, and one of the key areas that people said that they were interested in signing up for Disney Plus content was Marvel Originals. Well, they're not releasing those. There's going to be 5 in fiscal 21. There's going to be another Star Wars original show, a prequel to Rogue One in 21 as well. So we think there's a whole lot more content to come. They'll get consumers excited.
But aren't those Marvel fans just jumping on the bandwagon right away? They're not going to wait until the new content, the new original content is offered up, right?
I think that's certainly a piece of that, but I think there will be a leg of growth as well.
10 million's clearly huge, but is 7% stock price move a little too much given that?
So we have a $170 price target, and so we think optically, if you just look at the stock, it does appear expensive on near-term earnings, trading over 20 times earnings. But the way that we get bullish on the stock is, say, we do a sum of the parts valuation. We value the direct-to-consumer business 2025 revenue. We put 5.5 times multiple on that, discount it back, and the remaining part of Disney's trading at a 90% of the S&P multiple. So we think 170 is still upside to go here.
So you think that the market is going to take this company with $85 billion in revenue, with a legacy business, with cash flows, and all the rest of it, and say, we're going to pay a Netflix multiple roughly for the streaming piece?
For that piece of the business, certainly. I think if you
no
look
conglomerate discount.
I think if you look at it just on historical valuation ranges, you're missing a great asset they were creating. And so that's why when the stock was at 110 in April, there's actually a negative value for direct-to-consumer in there.
Roku's up a lot today, I think 4 or 5%. Does that make sense to you off the back of Disney's strong numbers today?
Yeah, I personally don't cover Roku, but I think it just shows that there's just a kind of just a snowball rolling down the hill in terms of streaming and direct-to-consumer. The OTT ad market's only about a couple billion right now. That compares to the SVOD market, about 15 billion. So with Peacock launching next year, I'm quite bullish on that. So I think we can continue to ramp from here.